shine so bright you might go blind.
The Quantum Financial System, QFS, is a cutting-edge initiative that uses quantum computing and satellite technology to create a secure and transparent financial network. It promises to eliminate issues like fraud and manipulation in the financial sector. It's like the financial world's answer to the technological revolution. The BRICS Development Bank is an institution formed by 5 powerhouse nations: Brazil, Russia, India, China, and South Africa. Its primary goal is to support public or private projects through loans, guarantees, equity participation, and other financial instruments. It's a classic example of global cooperation for mutual financial benefit. GESARA, standing for Global Economic Security and Reformation Act, is a global initiative aimed at providing universal monetary tranquility. It aims to create a level playing field with uniform rules and regulations to ensure fair economic practices worldwide. NESARA, similar to GESARA but on a national scale, aims to overhaul the American economic system. It addresses key issues like public debt, tax reform, and currency revaluation. It's all about creating a more balanced and secure economy. These initiatives are part of the ongoing transformation of the global financial landscape. The quantum financial system is introducing a new era of secure and transparent banking. The BRICS Development Bank is fostering international financial cooperation. GESARA and NESARA are working towards creating more balanced and equitable economic systems on a global and national scale, respectively. These initiatives are the driving forces behind the changes we're witnessing today. They're reshaping the landscape, setting new standards, and paving the way for a more secure, transparent, and equitable financial future for all. So keep an eye on this space as these initiatives continue to evolve and shape the world of finance as we know it.
Commercial banks offer a safe haven for your hard-earned money. Whether it's a savings, checking, or even a certificate of deposit account, these institutions provide a variety of options tailored to different financial needs and goals. It's not just about storing money, though. These deposits also serve as a funding source for the bank's lending activities. Commercial banks are the primary sources of loans and credit for both individuals and businesses. They help finance a multitude of needs, from home mortgages and car loans to personal loans and lines of credit. Businesses, in particular, rely on commercial loans to fund operations, expansion, and capital projects. Banks facilitate the secure and efficient transfer of funds by offering services like check clearing, wire transfers, and electronic funds transfers. This infrastructure enables individuals and companies to engage in financial transactions with ease and peace of mind. Commercial banks bridge the gap between depositors with surplus funds and borrowers in need of capital. By lending these funds to borrowers, banks earn interest on the spread between deposit and lending rates, directing funds to productive uses and stimulating economic growth. Banks safeguard valuable assets, important documents, and securities on behalf of their customers, ensuring the security and protection of their valuable possessions. Commercial banks offer investment advisory and brokerage services, assisting clients in managing and growing their wealth. This includes portfolio management, investment advice, and access to a wide range of investment products like stocks, bonds, and mutual funds. Banks facilitate currency exchange services, playing a significant role in the global foreign exchange market and enabling currency conversion and cross-border transactions. Banks assist businesses with cash management, liquidity, and financial risk management. These services include cash concentration, disbursement, and fraud detection, among others. Commercial banks are the backbone of a nation's financial system. They cater to a broad spectrum of financial needs for individuals, businesses, and the economy at large. Through their deposit-taking and lending activities, they play a pivotal role in the allocation of capital, fostering economic growth, and facilitating financial transactions in a secure and efficient manner. Commercial banks indeed are vital cogs in the wheel of the economy.
Ever wondered how companies raise capital or how governments fund their projects? It all boils down to the fascinating world of stock and bond markets. These two markets, while different in their mechanisms, are the lifeblood of the global economy. Think of the stock market as a bustling marketplace where companies sell pieces of their business known as shares, to the public. This process, the initial public offering, is a powerful way for companies to secure funding for their ventures, be it expansion, research, or development. But what's in it for the investors? Well, they become shareholders holding a stake in the company. This means they have a vested interest in the company's success. The stock market also serves as a hub of liquidity. Like a busy bazaar where goods are bought and sold, shares of publicly traded companies can be exchanged easily. This provides investors with the flexibility to convert their investments into cash when needed. And how does ownership transfer work? Simply, an investor can buy and sell shares without significantly affecting the company's operations or structure. This efficiency attracts new investors to the market. Price discovery is another core function of the stock market. The ever-changing dynamics of supply and demand determine the prices of shares, mirroring investors' expectations about a company's future performance. This is crucial for valuing businesses and making informed investment decisions. Investing in stocks does come with varying degrees of risk and potential returns, but the beauty of the stock market is that it allows investors to tailor their portfolios to match their risk tolerance and investment goals. Now let's switch gears to the bond market. It's the avenue for governments, municipalities and corporations to raise capital by issuing bonds. These are essentially IOUs, where the issuer promises to pay periodic interest and return the principal at maturity. Bonds fund various projects, from infrastructure development to corporate expansion. Diversity is a hallmark of the bond market. Investors can choose from a wide array of bonds, each with its unique characteristics, maturities, and risk profiles. This variety allows investors to diversify their portfolios and manage risk effectively. And what about the maturity spectrum? Bonds come with different maturities, from short-term to long-term. This range caters to the borrowing needs of issuers and the investment preferences of investors. To sum it up, the stock and bond markets are not just about numbers and charts. They're about raising capital, managing risk, providing liquidity, and discovering prices. They're about creating opportunities for companies, governments, and investors alike. They're the pillars of our global financial landscape.
Ever wondered how the financial world keeps spinning, how money moves from one place to another, creating wealth and opportunities? It all happens in the financial markets, with two key players taking center stage, the secondary markets and risk management. And overseeing it all, like a stern but fair referee, is financial regulation. Picture the secondary market as a bustling bazaar. It's where investors trade previously issued bonds, a marketplace not for the original issuers, but for those who bought at the initial launch and now wish to sell. This secondary market offers a fluidity that's highly attractive to investors, allowing them to fine-tune their bond holdings as market conditions shift and investment objectives evolve. But what about those who wish to tread cautiously, to manage their risks? Bonds come to their rescue, serving as effective risk management tools. Some investors might seek the stability offered by low-risk government bonds. Others, with a taste for risk and an eye for higher returns, might venture into the realm of corporate bonds or high-yield bonds, often termed junk bonds. The beauty of the bond market lies in its diversity, enabling investors to strike the right balance between risk and reward. In essence, stock markets and bond markets are the twin engines propelling the global financial system. While stock markets help companies raise capital and facilitate ownership transfer, bond markets enable debt financing and risk management. Together, they form the backbone of the financial markets, offering a plethora of investment opportunities and driving economic growth and stability. But what keeps these markets fair and trustworthy? Enter financial regulation. Government and regulatory bodies across the globe diligently oversee financial markets, enforcing rules and standards, and safeguarding the interests of investors. Investor protection lies at the heart of financial market regulation. Regulations are put in place to ensure that investors receive accurate and transparent information about financial products and associated risks. They govern the disclosure of information by issuers, investment firms, and financial advisors, creating an environment of trust and transparency. Market integrity is another cornerstone of financial regulation. Rules are in place to prevent market manipulation, insider trading, fraud, and other unscrupulous activities that could erode the fairness and transparency of trading. Regulatory bodies wield the power to investigate and prosecute those who dare to break these rules. Lastly, regulatory authorities strive to foster fair competition in financial markets. They curb monopolistic behavior, anti-competitive practices, and unfair advantages that some market participants might have. Issues related to market structure, such as the operation of stock exchanges and trading venues, also fall under their purview. To sum it all up, the secondary market offers a flexible platform for investors to trade bonds, while bonds themselves serve as potent risk management tools. Financial regulation ensures that these markets operate in a fair, transparent, and competitive manner, protecting investors and maintaining market integrity. Understanding these concepts gives one a clearer picture of the intricate workings of the financial markets.
Ever wondered about the invisible forces that keep the financial markets from descending into chaos? The silent guardians that maintain the integrity of the markets? Welcome to the world of financial market regulation, a universe that's as complex as it is vital to our economic stability. In the early days of trade, regulation was minimal, and financial crises were frequent. As economies grew and markets evolved, so did the need for a system to oversee these transactions. Enter financial market regulation, a framework that has evolved over centuries, adapting to the changing landscape of finance. At the heart of this system lie the licensed overseers, the broker-dealers, investment advisors, and asset managers. They operate under the watchful eye of regulatory authorities, who establish licensing criteria, conduct examinations, and enforce compliance with industry standards and regulations. But the realm of financial regulation isn't just about oversight, it's also about risk management. Regulations ensure that financial institutions and market participants have adequate safeguards in place. These rules cover everything from capital adequacy and risk assessment to stress testing and contingency planning, all designed to prevent systemic risks that could threaten the financial system's stability. And let's not forget about the consumers. Regulatory bodies establish protection measures to ensure the suitability of financial products and services for consumers' needs and risk tolerance. From mortgages and credit products to insurance and other financial services, regulations protect individuals and households from potential financial harm. In our increasingly interconnected global financial system, cross-border issues and harmonization of regulatory standards are crucial. International bodies like the Financial Stability Board and the Basel Committee on Banking Supervision facilitate coordination among regulators worldwide, ensuring a seamless regulatory environment. Regulatory authorities also wield the power to enforce these regulations. They can investigate and take action against violations, including imposing fines, penalties, suspending licenses, and even taking legal action against those breaching regulatory requirements. But the world of finance never stands still. Regulatory bodies continually adapt regulations to address emerging risks and changes in financial markets. They stay current with technological advancements, like digital currencies and fintech innovations, to ensure regulations remain relevant and effective. In essence, financial market regulation forms the backbone of our financial system, maintaining trust, stability, and fairness in financial markets. It provides the necessary checks and balances to prevent abuses, protect investors, and support the overall health of the financial system. The regulator's task, striking a balance between fostering innovation and maintaining market integrity, becomes increasingly complex in the rapidly evolving landscape of modern finance. To recap, financial market regulation is a dynamic, evolving framework that plays a critical role in maintaining the integrity of the financial markets. It oversees licensing, manages risk, protects consumers, coordinates internationally, enforces compliance, and adapts to market changes. So, the next time you make a financial transaction, spare a thought for the invisible guardians, the regulators, who work tirelessly behind the scenes to keep the financial markets fair, stable, and trustworthy.
Ever wondered how central banks influence the economy? They do it through a tool known as monetary policy, which involves the manipulation of money supply, interest rates, and overall economic activity. Let's kick things off with interest rates. Central banks have the power to adjust short-term interest rates, often referred to as the policy rate. This adjustment controls the borrowing costs for banks and, indirectly, for consumers and businesses. When central banks lower these rates, it encourages borrowing and spending, which in turn stimulates economic growth. On the other hand, when they raise these rates, it can help cool down an overheated economy, combat inflation, and prevent financial bubbles. Next, we have open market operations. These are conducted by central banks buying or selling government securities, usually bonds, in the open market. Buying securities injects money into the financial system, increasing the money supply. But when central banks sell securities, it reduces the money supply. These actions affect the level of bank reserves and consequently, the lending capacity of banks. We also have reserve requirements. Central banks can set these requirements, specifying the minimum amount of funds that commercial banks must hold as reserves. By adjusting these requirements, central banks can influence the amount of money banks have available for lending. Lower reserve requirements free up more funds for loans, stimulating economic activity. Lastly, in the realm of monetary policy, we have forward guidance. This is when central banks communicate their future policy intentions to influence market expectations. They may signal, for example, their commitment to maintaining low interest rates for an extended period to encourage borrowing and investment. But monetary policy isn't the only tool for managing an economy. Governments also use fiscal policy, which involves decisions related to taxation, government spending, and budgetary priorities. Taxation plays a significant role in fiscal policy. Governments can adjust tax rates, deductions, and credits to influence disposable income for households and profitability for businesses. Cutting taxes can boost consumer spending and corporate investments, while increasing taxes can generate revenue and reduce inflationary pressures. Then, there's government spending. Fiscal policy encompasses government spending on various sectors, including infrastructure, healthcare, education, and defense. Governments can stimulate economic growth by increasing spending during periods of economic weakness or recession. But during strong economic periods, they may reduce spending to prevent overheating and inflation. Finally, we have budget deficits and surpluses. A budget deficit occurs when government spending exceeds revenue. Conversely, when revenue exceeds spending, it leads to a budget surplus. Fiscal authorities use these deficits or surpluses strategically to manage the economy. Deficits can support economic recovery during downturns, while surpluses can be used to reduce public debt. In conclusion, both monetary and fiscal policies are crucial tools for managing an economy. They influence everything from interest rates to government spending, and can be used strategically to stimulate growth, combat inflation, and maintain overall economic stability.
Ever wondered about the mechanics of automatic stabilizers or the impact of infrastructure investment on an economy? Well, sit back, relax, and allow us to take you on an enlightening journey through the complex world of fiscal policies, monetary policies, and much more. We begin our journey with fiscal policies. These are the measures taken by governments to influence the economy by adjusting spending levels and tax rates. These actions can either expand or contract the economy, depending on the prevailing economic conditions. On the other hand, monetary policies are the strategies employed by central banks to manage money supply and interest rates, to maintain price stability, and achieve high economic growth. Now picture a system that operates automatically based on economic conditions. This is where automatic stabilizers come into play. For instance, during recessions, unemployment benefits increase, providing a safety net for those who lose their jobs. These stabilizers help to keep consumer spending stable during economic downturns. But what about infrastructure investment? Governments can kickstart infrastructure projects to create jobs, stimulate economic activity, and enhance long-term productivity. Imagine the ripple effects of building or upgrading transportation systems, utilities, and public facilities on various industries. However, the effectiveness of these policies is not set in stone. It depends on several factors, including the current economic conditions, the credibility of policymakers, and the flexibility of financial markets. And let's not forget the crucial role of coordination between central banks and governments in achieving desired economic outcomes. Moving forward, we introduce the quantum financial system, a technologically advanced financial system employing quantum computing for faster, secure transactions. There's also the BRICS plus New Development Bank, involving Brazil, Russia, India, China, and South Africa, which is reshaping the global financial landscape by providing alternative funding sources. However, it's not all smooth sailing. Picture the potential collapse of commercial real estate in the US. The health crisis disrupted work routines, leading to a drop in this market. Experts predict a possible 40% decline by 2030, impacting property owners and the broader economy. Some US landlords even opt for non-payment, believing it's more profitable than other choices, potentially triggering a crisis akin to the 2007 subprime crisis. But every challenge presents an opportunity. Creative solutions, such as converting office spaces into flexible, mixed-use properties, can help address these challenges. The commercial real estate sector faces challenges, but with innovation and adaptation, it can thrive in this new reality. So, what have we learned? Monetary policy manages interest rates and the money supply, while fiscal policy involves taxation and government spending. The quantum financial system and the BRICS, plus New Development Bank, are shaking things up, but challenges persist, particularly in the commercial real estate sector. Staying informed, diversifying investments, and adapting to change remain crucial for financial security and success in this dynamic environment. If you found value in this video, don't forget to like, share, and subscribe to our channel. Until next time, stay motivated, stay focused, and continue on your way to abundance. You are capable of it.